Welcome back, everyone, to another video by Fully Informed Trade, or FI Trade for short. My name is Alex, and I'm just going to go ahead and review the stock, commodity, bond, and Forex market. So without any further ado, let's go ahead and review these markets. Oh, I'm out of breath. But first of all, dollar index went ahead and finding some support and is consolidating just a bit. But remember, Euro-US dollar continues going on the upwards tear, and because of that, until we see anything change in the stock market, this market won't react positively. As you can go ahead and see, the Forex Euro-US dollar is finding some resistance, but the key area of resistance that I anticipate is going to be around $1.38. That's going to be a key area of resistance. However, if the stock market pulls back sometime later on this week, which it most likely will, which I'll cover later on in the video, but pretty much. This market could go a little bit higher, and 138 is the probability. Now, this charting software has pointed out some great trades in the Forex market, as it consistently does so over the longer term. This is one chart. This is one case scenario when this trade triangle technology is the bomb. First of all, I recommended a longer term trade at around 129, and it recommended a short term trade at 129, medium term trade at 134. And pretty much this market continues going higher. But here's one thing that I do want you guys to know, and I do want to point out, is that when the stock market pulls back in the United States, which it most likely will in the short term, what's going to happen is that a lot of investors are going to flee into the U.S. Treasury bond market. Now, it's not only going to be domestic U.S. stock investors that are going to do that, it's going to be foreign investors in other countries that are going to do that as well. For example, let's say you are a Chinese investment fund. Now, if your stock market is pulling back and you still want to achieve a rate of return, what a lot of people do, because bonds do appreciate when stock markets pull back. This is what they do. They cycle through. They sell their stock. They sell whatever the stock they have, whether it be in China, Australia, Europe. Let's say you're in London. You're a London fund then, okay? Because China is a bit hard, but London. Not London. I mean Germany, because London uses a British pound, but Germany. Okay, so let's say you're in Germany. You manage a fund. But what happens is that the whole overall stock market globally is pulling back. U.S. stock market pulls back, Asia reacts negative, they pull back, then Europe follows, but maybe pulling back a bit. So what's going to happen is that this fund manager is going to be like, okay, I'm going to sell a lot of my stock positions, get them off the table. I'm going to take my euros, the euros that I have, and convert them into the U.S. dollar. So I'm going to swap my euros into the U.S. dollar. That in turn will cause the value of the U.S. dollar to go up, the euro to go down, and that in turn will also cause the value of bonds to go up, because what's going to happen is that he's going to take his U.S. dollars and buy U.S. Treasuries. U.S. Treasuries will go up in valuation that much more further because of foreign investors. On top of that, dollar index will go up in response to that because of foreign investors fleeing into the risk-free trade. Next chart, I'm going to go ahead and review the gold market. Gold market, same exact story here. It is not safe, okay? And this is what I do want to point out clearly to you guys. Gold and silver has had a history of going up really fast and falling down really fast. That is the true reality. Now, as far as gold market going up consistently over the long term, that's hard to say, because I've seen the gold market pull back so much at some points in time that it took them decades to recover from their previous pullback. I mean, at one point, gold was at $800 back in 1970s. Now it achieved $800 in the year of 2009. So that took around 25 years for it to recover from buying at the near-term previous highs. So if you guys want to take on the risk of buying near the highs, that is totally up to you. If you're a short-term trader, it doesn't really matter, because you're going to buy into it, you're going to have a stop, it goes back down a little bit, and you're going to get your butt out of that position. But if you're a longer-term investor, it's really hard for me to say that gold is safe. Now, that doesn't mean gold will fall down by as much as it has in the past. But you got to consider this market fairly risky. It is pretty risky, guys. I'm not going to lie to you. And a lot of people are going to lie to you because they just want to sell you on some seminar. They're going to sell you on this book. They're going to sell you on some sort of product. Or they're going to sell the commodity itself to you guys and say that, oh, it's performed so great over the past couple years that it's going to keep on going higher. But me personally, I feel that it is risky to consider this asset class safe. Now, that doesn't come to show that this market is on a multi-year uptrend. But at this point, it has finally abated for the short term, and it could pull back quite substantially enough. Because remember, back in the past, 2008, 1000, it has gone all the way down to $700 before. Now, that's pretty much a 30% pullback. Right now, we're at around, give or take, we're probably going to see something around 10%. A 10% pullback would pretty much put us somewhere around, give or take, 1,200 area. Maybe a 15% pullback will put us at around the 1,200 or higher 1,100 area. So keep that in mind. This market will have a pretty strong pullback, and because of that, you got to play this market safe. Next chart is going to be the silver market. Silver market, same exact story. You guys got to play it safe. And this is how you're going to have to play it safe. First of all, if we go ahead and put the monthly chart in trade triangles, I recommended it all the way back at 1874, alright? Now looking at the weekly triangles, it recommended it back way down here. Now it's not recommending anything but to get out of your position at around $28.30. It recommended to trade back at 1874. So now at this point you would have kept most of whatever you made using this technology. But let me use technical analysis, or what I call street smarts, or whatever you want to call it. This market is trading below these two. Trading below these, between these two support levels, and this market is probably going to find some support around the $20 level. Now I've seen the silver market go down substantially in the past, and if you guys learned in geometry back in 8th grade or whatever, maybe 9th grade, I'm not sure, but pretty much what happens in geometry is that you have a slope, and pretty much the slope continues going down at this rate of pace. You know, remember rise over run? Well, just think of a negative rise over run, or fall over run, I guess you could call it. Boom, 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 boom. Right? And this is pretty much this. It has a similar looking slope, and because of that, if this slope was able to take this market down all the way down to around $8 or $20, that's a 50 to 60% pullback. The same exact thing could happen here, a 60% pullback. Now, is it likely? There's a possibility of it, and there is a high possibility of it. So be careful. Silver, gold, very risky. If you guys are trying to buy into it to get rich quick, that means that you don't want to lose money. So you guys want to get out of your position. Now, if you're really long-term investors, you already acknowledge the risk of buying into these commodities, and you want to hold them off, hold on to them for 20 years and not get shaken by the market. Okay, that's good for you. That is totally good for you. That's totally fine with me. But the longer term, guys, this is the most important thing. Over the short term, though, this market is going to get hit and it's going to get hard. So if you're trading this market, it's much more smart to short than it is to buy into it. And every time it goes up a bit, that is a dead cat bounce. Most likely, that's most likely just going to be a quick bounce. It's just going to fool you into thinking that this market might have found some sort of recovery, but it really has not. Let's go ahead and look at the next chart, which is going to be the bond market. Bond market, I recommended to trade right around 119.40 towards the bottom area of the trend of the channel. And now I'm telling you guys to get rid of it towards the upper end of a channel. Now you guys have just learned how to trade channels. It's not rocket science. Draw on the trend lines, watch the moving averages, trade buy at the bottom, sell towards the top of a channel. That's all there is to it. And this is the trade that I recommended on the bond market. I recommended you guys, if you guys go ahead and zoom back a bit, 5 days, I was thinking somewhere around 119 would have been just fine, and selling around 122 would make you money, and it would have made you money if you guys had just listened to what I just said earlier. Next chart is going to now as far as selling, yes. Now if the bond market continues going higher because the stock market finally decides to take a breather and pull back, it won't be too late to go ahead and buy back into this, even though it breaks above this trend line. But right now, this market has touched this trend line so many times and pulled back from it, it's not worth the risk to hold on to it any further. In fact, it's just much more smart to get rid of it, and then if it breaks above that trend line, then you guys can go ahead and go back into it at 122 onwards. Because the stock market is pulling back, the bond market will go up. That in turn will cause the value of a bond portfolio to keep going higher, and if you're trading bond futures will be really attractive from 122 onwards if you're looking to trade a trend. Now, if you're willing to trade a channel, this is how you trade a channel. If you want to trade a trend, you have to wait until 122 is broken. That's all I had to say for the bond market. Next thing is the crude oil market. Crude oil market, my previous videos, I kept on showing you guys the wrong chart, which was the February crude oil chart. Right now, I was supposed to show you the March chart, and this is the March chart. And as I've said and confirmed before, the crude oil market has been able to pull back quite a bit, and it has had the pattern that I was anticipating. Now, previously, I was thinking like, whoa, there's something wrong with this crude oil market. I was anticipating a pullback, and now I actually realized why I wasn't seeing it, because I was looking at the wrong chart. March chart. It is showing exactly what I was anticipating, so I'm going to give myself a quick pat on the back just because I was able to call the market right. I just wasn't looking at the right chart. Now, pretty much, markets continue going lower, and we're pretty much broken the 100-day moving average, and it's going to continue going lower after the dollar index starts to gain strength. Remember, when the dollar gains strength, that means weakness in commodities. Just keep that in mind, okay? Next chart is going to be the USO, which is the United States Oil Fund. I thought there might have been a quick bounce opportunity. There might have been a quick bounce opportunity off that level because it has been able to bounce off it multiple times in the past. However, That got totally negated when you got this bearish engulfing pattern on today's trading session. Negates that because this oil commodity, the real commodity, takes precedence and priority over a fund that is based off of the oil. So because of that, this market was going to pull back below that support level. It didn't matter what was there. It didn't matter if you had the iron wall of China right there. If the underlying commodity that this ETF is representing is going down, this ETF will go down. Next chart, tech resources. Tech resources is a play that I personally like, and it's because of one simple reason. It's a coal-based company that mines coal. Coal is a commodity that's going to be continually needed, and it's going to be used a lot in this coming decade because of the fact that developing economies like India and China are going to be using coal, and coal is going to keep on getting more expensive as an energy source in response to that. Not only that, Australian coal mines have been flooded, and because of that, the total supply or total global output has been reduced by around 5 to 10%. Top that with the fact that this market also is continuing to be strained by China demand and India demand, and it's only going to keep on getting worse because those industrializing countries are also the biggest manufacturing countries, and that takes a ton of electricity, and electricity will get more expensive as coal keeps getting more expensive. And because of that, coal should keep on going higher at the rate that the energy continues to keep on going higher in price. So if you guys don't want to be screwed on your electricity bill, what you guys want to do is buy into coal companies so you can say, haha, I'm protected. Because this is the best way to protect you against rising energy costs. Don't be the suckers. If you can't beat them, join them. And this is how you do it. Alright, next, this support level right around this trend line is going to be hit. If you can bounce off that, then great, but you should set a stop up, because set up a stop right below this trend line. If the market breaks below this trend line and it kicks you out of your stop, the next area of support is going to be $40. That's all. Next chart, Bank of America. Bank of America continues going lower, as I've already mentioned in the past, and I'm going to mention again. Bank of America is not where it's at right now. I mentioned it as a great short opportunity. The fact that it traded below the trend line, below the 20-day moving average, on top of the fact that earnings have already been announced, and it had an ugly looking pattern, which is the inverse hammer. Overall, Bank of America is still on a negative trend, and if you already own Bank of America, you should have hedged it a long time ago, bought put options to protect it, FAZ to protect it. We could have bought some volatility index, although I wouldn't have found that very effective, but FAZ and the put options would have worked out very, very well. And that was something I covered in one of my previous market review videos. Next, markets also are looking very negative on Las Vegas Sands. Las Vegas Sands is breaking below the major trend line. And also because of that, this is a really, really long-term trend line. It's a multi-month trend line, and that makes it even more important. Below the 20-day moving average, below the multi-month trend line, this is a really negative market. Stay away from Las Vegas Sands. A really great short opportunity. Target zone would be somewhere around $35 below. That's where Las Vegas Sands will most likely go, just because it pierced a key support level, and on top of that, the valuation on Las Vegas Sands does not make any sense. That's all for today, guys. If you guys want to use the same charting software I use, please be sure to check out the link below this video. And for all of you guys on YouTube who just happen to find me somehow, some way, please be sure to subscribe. It helps to have you guys support me. And if you're on Facebook, tell your friends about me. I really appreciate it. And I'm going to help out as many people as I possibly can in the coming weeks and months ahead. See you guys soon. Take care.